Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi, and tonight we take a look at the importance of staying focused. Now, whenever things are going well, it's easy to lose sight of basic investment principles and get caught up in the moment. We must never lose sight of the dangers out there, and with no clear systematic risks on the horizon, one needs to be aware of valuations within asset classes and individual securities. My guests this evening to talk us through this important theme are Andrew Dittberner, Chief Investment Officer at Private Client Securities at Old Mutual Wealth, and Dr. Adrian Saville, Chief Investment, or rather Executive Officer at Cannon Asset Managers. Now, before we get started, perhaps we need a quick refresher on what solid investment principles are. And Andrew, that does bring me to you to actually give us a reminder of what these principles actually entail.
Yeah, so I suppose if you look back through 2017, if we just use that as an example, here was a year where nothing went wrong. And we saw, economic growth around the world. We spoke a bit about it last week. And earnings followed suit, and we saw markets. I think it's very difficult to find, or I can't think of a market off the top of my head that went backwards last year. The JSE was up close to 20%. MSCI World, US, Europe, wherever it was. And I think people then, become, I suppose, an element of complacency can set in. People lose sight of, I suppose, what's important, and you get this FOMO investing, this fear of missing out. So you just want to, get involved by the, whatever it is, the talk of the moment, forgetting about underlying investment principles. Are the earnings there? Are they backed by cash flows? What the balance sheet looks like, etc. Let's just rather get in and enjoy the ride, or hope that the ride continues. And I think that's when people start to lose focus, and that's when, I suppose, an element of danger might, if you think of from an investment point of view, might arise.
And that's exactly what we want as investors, right? When things are good, we want them to be great and keep going great. And unfortunately, we never really anticipate the bad elements that might seep through. But you mentioned on the macroeconomic environment and many other things we take into consideration. But Adrian, what does this spell for investment fundamentals? Are we still looking at stock-specific indications? Are we still looking at the macroeconomic climate? Or are we just looking at the cycle of where the markets actually are? It seems as though it's a multi-pronged approach, which doesn't sound basic, but probably is.
I think the answer to your question, Gugu, is yes, yes, and yes. We're looking at all of those things. What I hear Andrew describing is an environment which is very friendly to momentum, that you just have to be sort of in the wind tunnel and you'll get a good result. The throwaway is sort of in a bull market, everyone's a rock star. But your investment principles and fundamentals really get tested when any one of the things that you've described or Andrew mentions, whether it's cash flow that gets strained, balance sheets gets pushed, some economic or market disturbance that's unanticipated. I think that's where investment principles really shine through. And the trick then, I would argue, is to not just have a very good sense and a robust grounding in terms of the principles that translate into investment results, but also constantly having a close eye on the various factors and elements in that environment, in the context that can stress or challenge your principles.
So many elements to certainly take into account here. But Andrew, what does this mean with regard to risk appetite, especially in the environment that we're in regarding complacency from investors?
Yeah, so I suppose, 10 years on from the global financial crisis, we've been in this environment of, very low interest rates. You've had quantitative easing, which I've, heard being described as monetary policy for the rich, as it's just pushed asset prices up. On the back of, solid economic growth, we've had this earnings growth. So you've had this, cocktail that's really resulted in this market that has, just become very investor friendly. And as Adrian says, very easy to trade from a momentum point of view. But if you lose sight and you start overpaying for assets, I think that's probably the surest way, to destruct wealth, is if you can have a great investment. I mean, a great business. It's a poor investment if you overpay for it. And I think that's probably the single greatest risk out there is overpaying. But alongside that, you can think of other economic factors. There's a huge amount of geopolitical risk out there at the moment that has just been pushed aside. Interest rates, everyone's got a firm eye on Jerome Powell, what he's doing, and how quickly, I suppose, the US increase the interest rates. Here you've got a president who doesn't care about debt, happy just to spend and spend, reduce taxes.
Yeah.
You know, so you've got this massive debt pile. And then a very inexperienced Fed chair. So I think you've got to keep a very, very watchful eye on him, how quickly they increase their interest rates, because I think that could be one of the clearest risks or dangers that reside out there at the moment.
Sure.
And I think the reference, the rude reference to George Bush, you have to cast your mind a long way back, was that he was a flip-flopper. You know, that he would change his mind on policy, and that I think is a real risk to any investment decision you take. Well, I would argue that Trump makes Bush look like an amateur hack when it comes to flip-flopping. That, you know, Trump will just change mind, shift tack, and often it's impossible to understand why he adopted the first position, you know, and then he shifts to a second position. You know, that type of policy regime, policy environment, I think presents a real risk to investing in this context.
Sure. So changing his mind as quickly as the weather changes sometimes in Cape Town, then potentially. With that said then, I mean, the both of you have obviously had years of experience within the market, and one has to ask themselves, do your investment principles then constantly stay the same, especially given that cycles change, as you mentioned, economic policies change, leaders within different institutions also change. So are investment fundamentals meant to stay that way? And for me as an investor, what kind of conversation should I be having with my portfolio manager as to how to manage these changing dynamics? Andrew?
Yeah, I think, investment principles absolutely have to stay the same. You can't lose sight of the fundamentals or get sucked up, you know, into the hype.
So don't change your mind like Trump, in other words.
Exactly. Don't flip-flop, you know, whether it's, you know, stay true to your style, because, you know, whatever your investment style might be, you know, you're going to go through cycles of, you know, times when you look great and times when you don't look so great. But if you start flip-flopping and trying to time it, you know, that's probably when you know, are going to become very unstuck. So yeah, I think your investment principles, you've got to remain focused on earnings. I know there's a lot of talk around, you know, the new technology businesses that are out there, and, you know, earnings don't matter. You know, you must only focus on cash flows, or, you know, whatever. So from a valuation point of view, you might have to try and value different companies differently. But at the end of the day, you don't want to be overpaying for a business, and you definitely don't want to be flip-flopping, you know, between investment styles, whatever your style might be. You need to stay true to your, I suppose, basic investment principle.
Yep, indeed. Well, that gives us a clear picture with regard to the macroeconomic climate that we're facing, and of course critical considerations to bear in mind. But what does this mean for the equity space? We've got quite a few stocks to jump into, gentlemen, in just a moment, but there's something critical that you mentioned earlier, Andrew, and that's overpaying for stocks, which creates some concern from my point of view with regard to have we maybe entered into a bubble territory with regard to certain equities in the environment? Let's get your perspective, and Adrian, if you've got something different to share, jump in there.
Sure.
Yeah, I don't think that the market's in bubble territory. You know, I think if we're going to talk about bubbles, you could think of, and this is outside of equities, you might think of Canadian housing. That might be a bubble at the moment. But I think if you look around equities, you know, around the world, markets are elevated, but I don't think we, you know, anywhere near the sort of levels that we were at in 2007, or if you think back to the .com bubble. I think those would be termed, you know, with the benefit of hindsight now, those would be termed bubbles. I don't think when you look right now that the market is a bubble. When you start hearing, you know, analysts, I read a report the other day from one company where an analyst said it's rational exuberance at the moment. You know, I think that's when you start. That's obviously a play on irrational exuberance from, you know, Alan Greenspan and Robert Shiller's book. But when you start hearing terms like that, I think you start to get worried that even professional investors, there's an element of complacency setting in here. So whilst the market might not be in bubble territory, and I'm talking, you know, around the world, yeah, the US, Europe, and that, I think valuations are elevated, and I think, you know, there will be certain areas and pockets within the market that are fairly expensive that I would be, you know, cautious about.
Yeah, I think if you cast your mind back to bubbles over the last 10 or 15 years, Andrew's flagged the two, you know, ones that really mattered or counted. There's big differences between what we see now and then. Late 90s, the technology boom and bust was very, very narrow. It wasn't everything that was inflated. So it was a confined or constrained bubble. By contrast, global financial crisis, it was hard to find anything that was reasonably priced. Almost everything was inflated, from tech stocks to gold. In the current environment, I would agree that there is inflation, but in places there are aspects of extraordinary overvaluation. Now, hindsight is a wonderful tool, but a great example is Bitcoin, where if you want any suggestion of risk just being thrown out the window, have a look at what Bitcoin did over the course of 2017, only to collapse into 2018. So there, without question, there was an example of incredibly bubbly pricing, and then specific examples. But I would venture that it's a bit of a push to say that everything is inflated, and in fact, in some places, I would argue that valuations are becoming far more reasonable. Government bonds would be a case in point, that they were outrageously priced 5 and 10 years ago. And there's a degree of sanity creeping into valuations there now.
Well, that's what we would like to hear as investors, because it certainly speaks to opportunity in the market. And one opportunity that we have as a stock pick is Continental AG. I'm a girl, I think tires, and that's it. Didn't think that there's much of an investment case here.
Yeah, so Continental, as you say, you immediately jump to it's a tire business. And historically, yes, it was a tire business. And it still does have the tire element to it. But, there's a strong theme of, autonomous driving, electric vehicles, this sort of thing. And everyone immediately jumps to the Teslas and, those sorts of businesses. But, when you start investing in those sorts of businesses, you talk about investment principles. I think here's a business that, continuously has to raise capital, has cash flow problems, has operational problems, doesn't generate any type of earnings to speak of, yet people are happy to get invested there. Here you have a company, Continental, you think it's a tire business, but it's actually not a tire business. I think only about 40% of their earnings today comes from tires.
Wow.
The rest of it is, autonomous systems, for, lane navigation, etc., infotainment, safety systems, that sort of thing, electric mobility, making cars lighter to increase the range of electric vehicles. So they play to that theme that everyone's talking about from a vehicle point of view, yet you just think of it as a tire business, and hence it's valued as a tire business, not as a business that's facing this huge disruption, from a vehicle point of view.
So clearly more to this one than just burning rubber, and maybe one to consider to put in our portfolio.
Yeah, absolutely. And I suppose even if you look back over the last 5 years, it's done exceptionally well as it's transformed itself. Outperforming, I think it's done about 130% over the last 5 years return in total. So it's done really well, and it's still not expensive.
I think, Gugu, that reference, Andrew's reference to people think it's this, but it's actually this. A similar example would be the German business BMW, which is Continental's helping put tires on, amongst other things. But when I say the German business BMW, that's the immediate perception. It's a car business based in Germany. Almost all of BMW's sales come from outside of Germany. The minority is inside of Germany. Its fastest growing market is China. It has about a quarter of revenue is now explained by this fast growing Asian market. And it was quick into autonomous driving and alternative energy cars. So the perception might be this, the reality is this, and you can buy a business like BMW on a single-digit price earnings multiple with a very elevated dividend yield. And to me, that ticks the box of it's a good business at a good price, and those are the two fundamental principles of successful investing. Have I got a good asset at a good price?
Exactly. So clearly teaching us something new, and of course understanding the new era of digitalization that we're moving into with a lot of traditionalist companies. We'll unpack a few more equities for you to know about and include in your portfolio right after this quick ad break. Well, we are back here on Portfolio Watch and taking a look at the topic, the dangers that lurk below. My guests with me in studio are Andrew Dittberner, Chief Investment Officer, Private Client Securities at Old Mutual Wealth, and Dr. Adrian Saville, Chief Executive at Cannon Asset Managers. Now, we've naturally painted a picture with regard to the macro environment when it comes to understanding fundamental investment principles and, of course, taking a look at some interesting stocks that we need to consider in our portfolio. We touched on Continental AG, but you also look at the Nikkei as an index and maybe one that we should also monitor its performance. Now, from a macroeconomic point of view, we did touch on Abenomics just last week, but what's still driving the fundamentals of this particular index?
Yeah, so I think if you look at Japan, going back over the last 10, 20 years, earnings meant very little. When you looked at the market, it tended to follow whatever the yen did. And looking at, if you just use the PE ratio, for instance, it really was very difficult to decipher whether the market looked attractive or expensive. Whereas today, I think it's decoupled to a certain extent from the yen. So when you look at the market movements now, there's a lot more demand coming from within Japan than just being a complete exporter. You think of Nintendo's, Toyota, those sorts of businesses that used to drive the market. Their profitability is improving a hell of a lot on the back of economic recovery. And as I said last week, here's a country that's flown under the radar. Everyone just has this sentiment towards Japan that it's done nothing for forever and it's going to continue to do nothing. But from an economic point of view, it's grown really nicely over the last couple of years. And from the market point of view, it's outperformed the S&P 500, the MSCI World, Europe, etc. So it's done really well. Yet it's still very cheap or attractively priced. If you think about, I think 40% of the companies there trade at below book value. There's more equities listed in Japan than there are in the US. So there's plenty of opportunity within Japan, yet no one likes it. And also the corporate governance has been an issue for a long time. So international investors didn't want to go there, whereas now they've really improved that corporate governance. They didn't have a corporate governance code until the last couple of years. Pakistan had a corporate governance code before Japan did. So they're getting it right now. There's a lot more demand. There's a tight labour market there. They're embracing technology, whereas the West is, the US, Europe are scared of technology because of the social unrest that's going to displace, work. People are going to become unemployed. In order with the aging population, for them to maintain output and grow output, they've got to increase productivity, and they're actually embracing automation. And you can think of companies like Fanuc, who build robots to automate factories, etc. So I think Japan makes a really interesting investment case at the moment, and it's not priced, for perfection like you might find in some other markets.
Just a quick one though, for a lot of us novice retail investors, when you go into the Japanese market, am I investing in rands, dollars, or the yen?
If you go directly into the Japanese market, you're investing in yen. You're exposed to the Japanese yen.
But I think just to add to Andrew's observation about Japan, there is to me a really compelling undertone to buying into the Nikkei. Is not only are you getting well-run businesses, increasingly well-run businesses at really good valuations, the rump of the Nikkei is actually multi-country, multi-currency. So it might look like you're investing in Japan, but just like my German BMW example, you're actually buying a business with global reach. And many of us know these brands well. Honda, Toyota, are probably some of the two best known, but other businesses like SoftBank, which has been a very successful venture into alternative parts of conventional industry, fintech technology. So I think Japan is a really interesting way to get access to these global assets at good prices, even if it feels Japanese.
So we like the Nikkei. What about Bank of America? Let me start with you, Adrian, to get your feel for it. Is this one that you actually hold in your portfolio at all? So
we don't hold Bank of America. We have held Bank of America for a long time. In fact, our first exposure to Bank of America in Cannon Asset Managers' global portfolios was just after a global financial crisis, and you could buy into the business at
a lot cheaper back then, right?
Half of book value. And it's been a very, very successful investment, as has all of the American banks that we've held in our global portfolio. JP Morgan, another good example. The American banks, I think, now are not outrageously priced, but they've become a little bit stretched, and so we think that there's better places to find that financial exposure than the mainline banks.
Andrew, you disagree?
Yeah, so
we have to disagree on at least one thing.
Naturally.
I don't completely disagree. You know, they're obviously more expensive now than what they were a few years ago, absolutely. But if you look at the macro environment, I think they've got a bit of a tailwind behind them. From a deregulation point of view, that's coming through at the moment. If you look at the macro environment, which obviously, you know, plays into the hands of the banks, so there are some tailwinds, and at a price to book of 1x, you know, Adrian speaks of, you know, trading at 50% discount to book value. At 1x, you know, I don't think they're outrageously expensive. Well, I wouldn't even say they're expensive. I think they're probably fairly valued in the current environment. So, you know, at Private Client Securities, we do own Bank of America as our only exposure to American banks. And if you look at their, you know, with the deregulation coming through, you know, I think their leverage increases slightly. They're not over, you know, if you think back to global financial crisis, you know, they're levered 30 times, now they're 10 times. I think they can, you know, increase that to 14, 15 times, which would see their profitability, you know, from a return on equity point of view, you know, increasing closer to 20% than the 10% where they are currently. So I think there is, you know, that tailwind coming through. I don't think they're exceptionally cheap, but I wouldn't say they're overly expensive at the moment.
Well, we wrap up with a stock that's another firm favorite for many South Africans. Maybe not a favorite, but one that certainly plays into their portfolios one way or another. And of course, when we think about this, we think about the valuation, the future prospects of earnings, and of course, exposure to Tencent. Naspers. Is this still one? I guess you can't ignore it and you can't really kick it out of your portfolio, right? What are the fundamentals about including this one?
Yeah, so I think the risk with Naspers, and I suppose it depends who you talk to. Some people are going to say it's outrageously expensive. Others are going to say it's attractive because it trades at this huge discount to its underlying investment in Tencent. So I think, you know, it depends who you talk to on that one. I think the risk with Naspers in particular is the size of it in the South African market, and having been overly exposed to a single company, you know, so with it making up, 18% probably of the all share index at the moment, we see a lot of investors having a huge exposure to a single stock, which I think is where the, you know, one of the big risks with Naspers comes in. The underlying investment in Tencent, I think Tencent is a phenomenal business. And I think, you know, being exposed to the Chinese consumer, the Tencent I mentioned to you, I was there recently, and I mean, it is all over the place, you know, paying for everything, navigation in taxi drivers' cars. I mean, these guys are really, you know, encapsulating the Chinese consumer. So I think the underlying theme of the Tencent investment is great. I think from an investment point of view, you don't want to have too much exposure to Naspers. Yeah,
if you extrapolate the Naspers exposure and you say one stock makes up 20% of the portfolio, and you do a simple Excel extension, by inference then you would allow 5 stocks to explain 100% of your portfolio. That's a lot of specific risk. Oof. You know, and I know it's a silly point, but if you want to debate in the South African investment landscape, this is the jump-off point. You know, what do you do with Naspers? So there's a high specific risk in this, and it's wonderful when everything is going well. But the way that we approach investing is not to start with, well, this is the upside and this is how well things will go. It's what's the downside? What if you're wrong on this? And if you are wrong on this, do you really want 20% of your portfolio in a single stock? So you could get exposure if you're able to allocate globally to a company called Taiwan Semiconductor.
What do they do?
They manufacture semiconductors, and there is an exceptionally good chance that it's in whatever handheld device you've got in your purse today. So Taiwan Semiconductor is Taiwanese, obviously, global reach, single industry, semiconductor, but like this cluster of sensors, semiconductors, it is growing extremely quickly. It has been for the better part of 2 decades. And if you had been invested in this business, you would have had a return better than Naspers.
Wow.
You can now buy it on half of Naspers's valuation.
Goodness. Okay, so interesting dynamics that are certainly coming through there. And of course, different companies with different prospects. But of course, the investment fundamentals still looking positive for many of these companies. Thank you so much, gentlemen, for giving us a heads up on the many dynamics that we do need to consider, especially when it comes to maintaining our investment principles and some stocks for you to look out for. Just a quick reminder on some of those stocks: Continental AG, the Japanese Nikkei as an index, Bank of America, Naspers, and if you're really quite bold, maybe Taiwanese Semiconductor, right? One that you might have in your phone. A big thank you to both my guests for joining us on today's edition of Portfolio Watch. Dr. Adrian Saville, who's the Chief Executive at Cannon Asset Managers, and Andrew Dittberner, Chief Investment Officer, Private Client Securities at Old Mutual Wealth, for sharing their thoughts with us on tonight's program. Now, next week, do be sure to join us as we shift our focus to the exciting times that we're living in, given the innovation and disruption that's currently taking place. One certainly needs to be aware of the risks, while at the same time, you want to make sure that you're not left behind. Join us again next week at the same time as we unpack many of these themes. And remember, you can email your questions to portfoliowatch@abn360.com and send your tweets using the hashtag PortfolioWatch. Join me again, Gugulethu Mfuphi, next week. Until then, it's goodbye.